3. Welcome to all of you watching this webinar for the first time. This is the first of a series of webinars that we are going to run and present to you about the mysteries of taxation for international business transformations. It's really important to realize that most multinational companies make those changes more than once during their lifetime, and they look at changes how to operate, changes where to sell their products, expanding into new markets, whatever reason you may have to make those changes. When you go through those changes, you have to realize that taxation is a very important element to consider. It's certainly not the most important, but it's one of the most important factors to consider. And in this webinar and in the next series of webinars, we're going to take you through the journey and share with you what are the potential pitfalls, what are the solutions that you can think of, and how can we ensure that when you are going through this business transformation yourself, that you end up in a smooth process and you have a result that you like. When I say we is Blue Turtle Tax and Quantera Global. And I'm here today with Theo also from Quantera Global. So Theo, can you please introduce yourself to the audience?
Thank you for a nice introduction, John. My name is Theo Elshoff. I have over 30 years of experience in the field of transfer price and other areas. I started as an in-house tax expert some years ago, went to the tax authorities, where I was key member of the transfer price knowledge group and leading the APA team. Went to the Big Four, where I met John. And for 11 years now, I'm co-founder of Quantera Global, fully dedicated on transfer pricing. So nice to be here.
Thank you, Theo.
Yeah.
And it's good to be reunited with Theo again after so many years.
Mm-hmm.
I'm John Sloot. I'm with Blue Turtle Tax. I'm actually indirect tax and supply chain specialist. And I've helped many companies with the transformation from existing business models to a new way of operating, and have helped them understand the completeness of a project like that. What is really important is that to consider that if you are considering a business transformation, it cannot just be about tax or finance or strategy. There are at the minimum 12 different work streams that you need to consider. We will discuss those work streams. Each work stream will be addressed during one of the webinars. And we will make sure that it makes a logical follow in a logical order, and that it will give you a lot of insights in these projects. And hopefully at the end of it, you will be very excited to start with your own business transformation. So the first topic, where I think is most relevant for business transformation, is about transfer pricing. So before we do that, it might be good, Theo, if you give us a definition of transfer pricing.
Transfer pricing is the prices that an enterprise charges internally to the other associated companies for goods, intangibles, and for service and financials. So it is the total package.
Okay.
And the price that they charge for those kind of transactions.
Yeah.
That's in the main it. And for tax, it is important for transfer pricing that is arm's length, meaning that you can defend it towards tax authorities in all the countries. And nowadays, transfer pricing on the radar of all the tax authorities. So it is important that you don't only be able to tell it, but also do it and show it. That means a lot of compliance and documentation as well. And that's the current landscape. So how to deal with it is, in some words, you first have to define your strategy, the risk strategy towards the price setting of it. Meaning that for all what I just mentioned, the transfer prices, they should be with certain ranges. So the outcome of a sales organization should be within certain ranges.
Yeah.
That you have a net profit that the local tax authorities understand it. So what you need to do is first set the pricing for your company and the risk attached to it.
And I understand that, Theo, but my experience has been different. And you and I had many discussions about it in the past. Because you set the price, you try to stay within your range, and then suddenly when year end comes, you realize you're way out of your range and you have to make quite a big change. And then my clients start to worry from a VAT perspective, because we have to make those changes.
And therefore it is so important that you first set the prices within the range, that is in the budget.
Yeah.
And then that you identify what your ranges that you can walk on.
Yeah.
Because within a certain range you are okay. That's transfer pricing.
Yeah.
And if you have done it, then the next step is monitoring it.
Mm-hmm.
Meaning that budget to actuals and forecasting, you look where you are in those countries, and then you say, let's maybe do something on the pricing. Yeah, that's going forward, so that you don't go backwards, so that you don't have your VAT and custom items, because that's with year-end adjustments. Then, in fact, you go back the whole year.
Yeah, and I think that's and that would be already a step forward, if at least from a VAT perspective. If we can avoid backwards price adjustments, we're fine. Customs, we have to realize that, and we have to make that very clear. Customs thinks exactly opposite from the way normal tax people. I'm not saying customs people are not normal, but the tax people in general have a way of making sure that the profit allocation between group companies is fine. The customs authorities, whatever you do, always believe that your price is too low. And if you start making changes, upward changes in a proactive way, so in a forward working, they will still try to challenge your previous customs filings. So VAT, that would be the perfect solution. Customs, I don't think there is one solution that will work around transfer pricing adjustments. You will always be caught.
And therefore your headache or stomach ache sometimes on that field. I understand that. I don't like that Excel-based way of working within ranges. I understand that you do it. But if there's a material difference between what you thought the outcome would be and the actual results, look into it.
And I would guess, based in today's environment that we live in, with all the access to data and the ways that it's very easy to actually monitor, because you said monitoring is fine. And monitoring, I think, could almost be done on a real-time basis. I don't think it's necessary, but if you set up a proper functioning data lake, where you can make your analysis on a regular basis, then you would not be surprised months later after the fact, and you can interact much quicker. That's where I think is a strong believer. So price setting, monitoring is fine, but if you do your monitoring fine, you can make your forward adjustments relatively simple, I would think.
That's true, because then mostly if you do it and start with monthly looking at it, because I think it is also time consuming, then you're still 11 months in a year to make it happen. But if you do it on December, then you only have one invoice to go. And that's, I think, the difference. One example about looking into why it is a material difference is I once had a problem in a country, one country, and on a sales organization that had losses that I didn't understand. And then I saw that it was the product for that country was not suited for that country. It's homologation, etc. problems. And they didn't have a product for 3 months. And then you don't go into transfer pricing adjustments forward. No, you see what's happening and you calculate compensation for what's happening, because that was not caused by the sales organization, but the principal.
Yeah, exactly. By not providing the products that they could deliver to the market, then forecasting is out of the door. You're simply not doing anything, and then you will be way out of your range. For sure.
Because you have to also document price changes. There would have been such a tremendous price cut that to get the prices up again, but the problem is not there anymore, and why it is different is difficult. So material difference, look into it. I think that's also main message in this field. And last, if you have to do a year-round adjustment, talk to the VAT and the custom people as well.
Yeah, thank you.
Because I understand. Because otherwise, you can maybe do it in a way that is not seen as a price adjustment, but something else. Which doesn't get you into of limit indeed the problems on VAT and customs.
If you're more interested in the impact of transfer pricing adjustments on VAT, then at the end of the webinar there will be a recording that we did previously, a short video on my views on transfer pricing adjustments and VAT, and hopefully you will agree with me that it should become something that you should be less concerned about. But let's move on. So the transfer pricing in itself, what are the main drivers?
Transfer pricing is in fact not a tax instrument. if you look at it, is this really for the business, economic? Therefore, it is there. And what transfer pricing for tax did is just look into transfer pricing as a way of communicating on arm's length outcomes.
Okay.
And that's tax and TP. But in the basis, it is an economic principle. First time, it should have, like I said, the goals and the strategy. It should support it, transfer pricing. So that everybody within an organization does what he should do and is accountable for what he's done. And that's the second one, performance evaluation.
Yeah.
So that transfer pricing should, I always say, a sales organization, you are not measuring on the cost they make.
No,
that should be, so cost plus for a sales organization doesn't seem the right answer. That's that tax comes in a little bit, but that's the way the transfer pricing economical look at it.
And is that how you and why you use KPIs?
Yep.
Key performance indicators to actually make the people in the group organizations aware of what they need to be focused on and those what they don't need to be focused on.
And those KPIs is so important for me as also tax to understand what the right remuneration will be, not only the markup or the commission percentage, but how they should be remunerated on cost, on sales, or maybe something else, or even share results. And that's the KPI part. The third part is the transfer pricing also make people empower people to what they do.
Yeah.
By setting a budget, by setting the KPIs, you say to something you are responsible for, accountable for.
Yeah.
And those transfer pricing should also do that part for the company. It is related to performance indicators, but it really delegates autonomy to the people in the company.
Yeah. So if you recall the first slide that we put up on all the different work streams, that's immediately visible now. How transfer pricing is touching many of those other work streams, because it will be a main element that sometimes will drive and sometimes will support what happens in those work streams.
Exactly true. And because when I do transfer pricing, go into a company, then it's a start with strategy. It goes to accountancy. It goes to tax, TP, even sometimes ASC at the moment. The last one, maybe it should also be maintainable. Don't make it too complicated, because otherwise it is not implemented and maintained.
I think that comes from I think your key criteria for transfer pricing, right? Let's do that for a quick and dirty for the audience.
Each time when I'm asked to look into the transfer pricing aspects, I say I have 4 elements to discuss with you. It should be first in line and support your strategy as a business. Yeah, because otherwise it doesn't make any sense. You have to also defend it, make use of it, so it should also be within your boundaries of strategy and help you. That's the first one. And next one is also keep it simple, stupid. Keep it simple. Yeah. Why? Because it has to be implemented and maintained and maybe sometimes changed. So the whole thing should be understandable, and not that that you have to have some theory behind it to understand it almost. Yeah, that's really important. Yeah. The third one, and that's also key, it should be compliant. So in that means that what you have done there should not immediately trigger all the local tax authorities because you don't understand it. It should be compliant.
I think that's one of our main drivers always. No surprises. Know what you get yourself into, and know how to actually run your business in the way that you are not being disrupted by tax.
And the last one is it should be tax efficient. So it's not on tax savings, but it should be you should be still being competitive to others.
In the past, I think most companies that were helping companies with the restructuring kind of focused on being tax efficient, and that always had a negative ring to it. And I think we should basically get that negativity away from there, because the way you mean tax efficient is that it should just be simple. It should fit your criteria, and it's not intended to as a tax planning element, because the way you've introduced transfer pricing for me, and it becomes more clear and clear every time we work together. I learned something more, which is good. I think it's all about transfer pricing is not a tax-driven exercise, it's an economic exercise, and you basically try to picture a company and then apply those margins between group companies. So that's perfect. What we probably should focus and move towards now then is the second part of the focus of this session is the public opinion. You've just given your criteria for transfer pricing, and I think there is a fifth element that maybe should be added to that, which is the public perception. So 10, 15 years ago, we were surprised in the Netherlands by the Starbucks case, where the European Commission probably accused Starbucks from state aid. Yeah. What happened there?
Yeah, it's a good one. I think really the fifth dimension is something that kicked in. I never forgot Apple, the CEO saying, I pay every dollar I legally owe. I think that's a saying he wouldn't do again.
No, even though he's right.
He's right, but that's the public opinion. And the Starbucks was beginning of it, like the Apple case, Starbucks. What was Starbucks? In fact, an APA for the Dutch tax authority. And I put it in simple terms, but we have helped to write a full book on Starbucks. So there's a lot to tell about it and the whole structure. But in simple terms, they had an APA for manufacturing, toll manufacturing with the cost plus. And that was it. And indeed, that was also the activity in the Netherlands. Yeah. So from transfer pricing professionals, they say, what the heck, why are they going to bother on Starbucks? But what was the case, a lot went through the company. Things that the royalty payment that was done by sales organizations abroad to the Netherlands was paid to a company that had a lot of substance on IP.
Okay. No. And that followed the same cost plus approach.
Yep. And in the main, and next to it, the green beans of Starbucks came from Switzerland, also went through the company with a price on the green beans to the manufacturer that was not regarded as arm's length by the EU Commission.
Okay.
And that also enhanced the cost price of the products which went for the Netherlands to like the UK, where there was a big problem on it. Because all those cost price increases led to a high price to the UK. Yeah. In the UK, a lot of revenue, but almost no tax. Yeah. Because the cost price was so high that they couldn't make results in the UK. And that was the reason that the EU Commission said there's something wrong here. Yeah. But they attacked an APA that was okay. Yeah. So to my recollection, the outcome for the court case was no state aid, and indeed it was not state aid. No.
What's the definition of state aid, by the way?
Yeah, state aid, then you grant as a state some incentives to a company. Yeah. Which is not in accordance with normal law and what you should do. Yeah. So there's really a present of the country to the company and not to others. But it was not really something that came out of the treasury of the Netherlands to the company.
No, so the Commission wrongfully basically took the Dutch APA as to put an example into the public domain and explain why companies like the company that we're talking about did something wrong, even though there was nothing wrong with the Dutch APA in itself. Yeah, but the execution was.
Yeah, but you have to understand the politics behind it. The European Commission made a stand there, and that was a reason that afterwards all those kind of new elements came across, like the pillar 1 and 2, the BEPS, base erosion profit shifting. That was the OECD, but all those kind of items came across. Why? Because in the public debate, they could say all those companies doing tax structures, we should end it. So you can do almost anything with the companies. So transparency, documentation, I'm not against it, adequate substance.
No, there's nothing wrong with transparency,
but sometimes the medicine kills the patient. And there's so much burden on compliance nowadays, and there's more and more coming on. We should think what makes sense to
So in your criteria, basically, when you say compliant, you also mean being compliant with the public perception. I hope we haven't basically scared people off from moving in towards a business transformation, because I think if you prepare it well and remember that the legislation around this has changed dramatically in the last 10, 15 years. There's a lot more things that you know in advance now, and you can prepare for that. And that's basically what we have been doing for many years already. And I think it would be good to basically take the audience through the process that we apply when we do a project for you.
I think the next step is to see how the magical of our combined approach works. As Blue Turtle and Quantera Global, I think we have a perfect way of working together, and that's the basis as a team. And that we really combine things. That we really go for the total approach for a company. So that we have all the work streams.
It's basically our way of keeping structure in a project, and also to make sure that not elements are lost somewhere in the design phase or in the implementation. That would be painful if one of those elements would not be taken into consideration.
It's like walking in a house and then the basement is not okay. So everything should be there. Mostly start with strategy of the company. I think that's the basis. To look where they are, what they're going to change, and how to define the optimal way for transfer pricing. If I look at it, and you for VAT and customs, and you combine it, because if you do design of it, then the transactions can change. For transfer pricing, I get the question which transfer price model is optimal with all those criteria. And then they look at you because the transaction is happening. Is this also optimal for VAT and customs? And from that onwards, we can set a basement there, the basis. And for that on, we can look at the other topics. Because they also should be looked at, like accountancy, etc. It's all about the totality.
All of them in our workstream overview are equally relevant. Some require more attention than others, and may have more emphasis in the different phases of a project. I think it's also fair to let people know that a business transformation is not done in 3 weeks. It takes a lot more time to complete, especially the more change in your operating model and in your markets, the more you have to do in advance to make sure that once you go live with your model, that it actually functions. And one of the things that I always like to emphasize is that each of those processes have a linkage. So the way that we look at it is the interdependencies between those work streams. If you think about changing your business processes, around the business processes, you will see all the different work streams that are relevant for the workstream business processes to take into consideration and to at least patch into the design before you start changing any business process at all. So that was basically the wrap up for today. Thank you, Theo. I think we will move on to, there will be a next seminar. Which will be the next webinar?
We will talk about business models, etc. We're going to dive in it a little bit, and then, like today, see if what questions comes up, so they can really do something for the audience.
Are you going to address all the different business models?
The main ones, I think, but there are, like you understand, there are more and more business models than we can imagine.
Absolutely.
And sometimes a combination of those as well, because the business is developing and not all business parts are developing in the same manner. So that's more than that, but the main principles.
Okay, good. And then by closing this, thank you for listening in. If by listening to this webinar you think like, hey, this is interesting, but I hope they pay attention to topic A, B, or C, don't be shy. Just drop Theo or me a mail with your ideas, your comments, your questions, and you'll find our details, by the way, in the end of the webinar, so it's easy to approach us. And we will factor them into the next webinar or webinars without calling you and trying to make this cold call sales effort. We're not interested in that. But we are interested in your comments and your questions. And hopefully you'll be watching us in the next episode of The Mysteries of Taxation during business transformation projects. Thanks for watching. Delicious. What a beautiful day. It's such a pity that I have to talk to you about transfer pricing adjustments and VAT. Are you that person in the company that's responsible for managing the profitability of your group companies and have to make those year-end adjustments, then you're the person I need to talk to. So when you're actually making those annual adjustments, you need to make a decision on what you're going to do with it from a VAT perspective. There are three options for you. The first one is the most complicated. You are basically saying that you are correcting all your previously issued intercompany invoices and make a corrective invoice for all of that. That's a lot of work. So what other companies do is they treat it as a separate VAT event, make a single invoice and post it accordingly. But there is a third option, the option I like most, that you don't have to do anything. Year-end adjustment is simply not in scope of VAT. That's what you should aim for. Over the years, local tax authorities, supported by decisions made by the European Court, have told you whenever you make a transfer pricing adjustment, you need to treat it like a vettable event. And you need to change your previously issued intercompany invoices accordingly. Luckily for you, there are currently 3 cases pending at the European Court that are going to make a big change in your favor. So now it's time for you to pay attention. At Blue Turtle Tax, we are of the opinion that transfer pricing adjustments are not in scope of VAT. If you make sure you have the proper setup, have the right set of documentations, and you give the proper instruction to your finance employees, you will create a situation that cannot be caught by transfer pricing adjustments being a vettable event. So if you want to know more, or you need our help getting to that situation, look up our website, find the right vet contact for you, and we can have a perfect chat about that.